Hello everyone, good evening. Good evening everyone, and very warm welcome to all of you. So today's session is on BRSR Assurance Readiness for 2025-26, a topic that is no longer optional or future oriented for listed companies. So let me set expectations clearly from the start. So this session is not theoretical. I am not going to read out SEBI circulars or repeat what is already written in guidance notes. Everything I will say today is based on actual BRSR core assessment and assurance engagements. Whatever experience we have gained from past projects. So that is what I am going to discuss today. So we have faced situations where we have where data were questions, number were recalculated, evidence were cross-checked, and in some case, assurance conclusions were qualified or questioned. So I have personally seen situations where companies were confident internally, but struggled badly once assurance testing actually started practically. So today's our title is prepare for BRSR assurance with confidence. And from experience, confidence does not come from templates or consultant slides. Confidence comes when systems are stable, control are documented, evidence is retrieval with minutes, and management understand exactly what they are signing off. That is what we will focus on today. Uh, Let us start with the slide number 2. So, yes, let me explain very clearly why 2025-26 is such a decisive year. First, BRSR is already mandatory for the top 1000 listed entities. That debate is currently over. So, secondly, BRSR core issuance already started in 2023-24. This is important because many companies still talk about assurance as a future event, whereas in reality, assurance is already happening in India. I have seen companies in financial year 23-24 where management assumed limited scrutiny, but assurance team asked for transaction level data, recalculate KPIs independently and raise observations. So I think in March 2025, hope we all know that SEBI introduced uh, flexibility and simplifying value chain rules. Now, let me clarify something very important from practice angle. This flexibility reduced implementation pressure, but it did not reduce expectations on data quality, documentation, or traceability. Fourth thing is that in December 2024, industry standards were issued. So this changed the game completely. Earlier, companies could say we followed an internally accepted methodology. Now, during assurance, that argument is no longer exists. So Indian standards legally define like calculation logic, including exclusion rules and documentation expectations. Now add one more critical point. From to financial year 2025 and 26 onwards, value chain ESG disclosures also start applying. So when I combine all this in assurance terms, the message is very simple. 2025 and 26 is the last stable year to fix data architecture, governance, controls, and evidence. Anything not fixed this year will surface under pressure in financial year 2026-27. And under pressure, you all know these issues will cost more, it will take longer time, and will escalate at higher level. That is why this year will decide whether your future assurance is structured and calm or reactive and stressful. So it completely depends on this existing financial year. Let me take you on slide 3. So here we are going to today discuss what agenda we have set for our today's webinars. So for today's session, and I will also discuss why I have structured this agenda today in this way. So first, I will give you a quick refresher on BRSR and BSR code, because in assurance, misalignment on basic creates very confusion later. So, and second, we will walk through the regulatory timeline from 2023 to 2027. So you clearly understand what is already applicable, what is transitional, and what is coming next. Third, we will discuss assessment versus assurance, not from a textbook perspective, but from how assessors actually test data and how much effort companies underestimate. Fourth, I will say common readiness gap observed in financial year 2024 and 25. And these are not hypothetical. So these are real failures we have seen during reviews and our site visit. Then we move into best practices that actually work, not ideal practices, but practical ones. After that, we will deep dive into value chain readiness, because this is where future assurance risk is building quietly. And finally, we will close with a readiness checklist and an external assessor's lens. How an assurance team actually think when they review your organization. So let's start with the BRSR and BSR code. Quick refresher. So before we go deeper, let's align on fundamentals about BRSR. So BRSR has three broad sections. First is general disclosure. This includes company profile, operations, location, and policy disclosures, aligned with the 9 NJRBC principles. Second is management and process. This is where governance actually shows up, like board oversight, committee structures, internal systems, and decision-making process. Third is principle-wise performance data. This is where most of the numbers sit, environment, social, and governance metrics. Now, with these structures come BRSR core. BRSR core is not a, I mean, it's not a separate report, but we can say it is a subset of critical quantity KPIs. And it is selected specifically because they are considered suitable for third-party verification. So like examples, we can say GHG emission and intensity, energy mix and renewable share, water usage, safety metrics like LTIFR, wages and gender pay ratio. Now here's the key assurance reality from financial year 24-25 onwards. PSR core KPIs have to be strictly follow Indian standards. So what does it mean? So it means formula should be prescribed, boundaries should be prescribed, documentation in detail is expected. So earlier interpretation risk where existed, were there. Now interpretation risk reduces, but assurance risk will increase because numbers can be directly challenged against standards, right? let you Let me take you to next slide. So next slide is our regulatory timeline 2022 and 2027. So hope many of you knows how BRSR have evolved from BRR, and then how it become BRSR. So let me just give you its journey, its regulatory timeline in short to all of you. So like in 2022 to 23, BRSR came mandatory for the listed entities. At this stage, assurance was non-mandatory and scrutiny was largely disclosure based. Then again, in next financial year, BSR core assurance begin for the top 150 entities. This is where company first experienced like recalculations of their ESG KPIs, sampling of their site level data, and governance questioning by their assurance team. Then came financial year 2024 and 25. So here in the industry standards become applicable. This remove basically methodological flexibility. Then currently we are in 2025 and 26 financial year. So here value chain ESG disclosures start applying in phased manner. In financial year 2026 and 27, where value chain ESG assessment and assurance will become uh, mandatory for few of the industries. So the progression is very clear. First, your internal data is assured. Next, your supplier and partner data will be examined. So in assurance language, we can say that if your internal systems are not stable today, and extending assurance to the value chain will be, I mean, it have to be you have to magnify every weakness in your data. So you have to become stable and assurance ready from this financial year, existing financial year. And this is why financial year 2025 and 26 is a buffer year. We can say it as a buffer year. Next slide, we are going to discuss about assessment and assurance. So this slide is extremely important because many organizations misunderstand this distinction. I am talking about organizations which are currently not facing assurance right now. Already top 500 are in this domain, but industries which are uh, going to face this. So for them, this slide is very extremely important. So an assessment is basically a structured third-party evaluation aligned with the industry standards. So it focuses on identifying gaps, checking consistency, and suggesting improvements on that. Identify whatever they have identified gaps or whatever inconsistency they have found at the site level. So they can recommend. I mean, consultant can recommend them improvements. It will not always follow full formal assurance standards. And like assurance is conducted under standards like IC 3000 or AA1000 AS. So we are conducting assurance on basis of these both standards. So this involve in compared to assessment, assurance involve qualified assurance professionals, formal sampling, control testing, documented working papers, and a formal conclusion what assurance advisors have to present. So now here is the practical insight from the experience. Even when companies opt for assessment instead of assurance, assessors still expect evidence, still expect traceability, and still challenges weak data. So choosing assessment does not mean you can relax discipline, right? The difference is in conclusion format, so and not in data rigor. So let us move on next slide where we are going to discuss assurance readiness. Assurance readiness is not a checklist like we prepare checklist and on that basis what we do in assessment. So this is not just a checklist. It is we can say it as a maturity ladder, right? So first we check here governance readiness. I have seen engagements where numbers were accurate, but assurance scope expanded because board oversight was weak, right? In governance, it is unclear. Assessors increase testing because accountability, I mean, we can see that accountability is unclear. Second thing is that scope and boundary readiness. One of the most common failure. Financial consolidation includes an entity, but sustainability reporting excludes it. So this immediately triggers reconciliation issues here. Third one is data readiness. Every KPI, I mean say every KPI must have an owner, a system source, and a documented formula. If data leaves in personal Excel files, assurance risks increase automatically. And fourth, we can say is control readiness. I'm not talking about policies. I'm talking about actual controls like approvals, reviews, and validations. Fifth is evidence readiness. In assurance, no evidence means no acceptance. If you are not able to provide evidence or traceability of your data, whatever you have present in your BRSR report or we can say sustainability report, so that means it is not acceptable if you have no evidence for that, what you are presenting. And finally, alignment readiness. So number may look correct internally, But if they do not align with the standards, so they will fail. I mean, assurance will fail there. So, main key point we can say here is assurance failures rarely happen because of one big mistake. They happens because several small gaps exist across this ladder. Like if you have several KPIs, you are reporting your several KPIs, and you have a small mistake in each and every KPI, each and every data what you are presenting, or you are failed to present your data. Sorry, you are failed to present evidence against your data what you have present. So obviously that will make your assurance seems like it has been failed. Now let me bring you to the real ground reality of what we see inside organizations during BRSR. In fact, we have done ESG and sustainability assurance. So this is going. We are going to. I mean, what we have experienced on site that I'm going to explain. So the single biggest governance gap from governance perspective, what we have seen is that BRSR is treated as a reporting or a compliance exercise, not as a governance responsibility. In many companies, BRSR is handled exactly like this. One team works on it in the last quarter, or numbers are compiled. Like it's not just a number. I mean, they prepare slides and presentations, and someone fill up that form. So it's not like that. So from an assurance perspective, this is a really a weak governance signal. The first major gap we see in the absence of single accountable ESG or BSR owner. Like responsibility keeps shifting between uh, hope you might have been from different industries. What we have experienced that usually BRSR is treated. I have seen a lot of department handling it in different companies. Like somewhere it handled by sustainability team. There are few companies where BRSR is handled by finance team or someone from compliance team. In fact, HR team. So the HR teams are handling BRSR assurance and this reporting system for BRSR. Sometimes EHST. And during assurance meeting, when we ask a simple question like who owns this KPI end to end, the answer is often unclear to us. So when ownership is unclear, accountability will collapse. And I mean, assurance scope will expand. There isn't any questions regarding this. So there should be ownership of data, ownership of KPIs. And the second gap is that board and audit committee charters are, I mean, basically they are silent on BRS and ESG assurance. In multiple engagement, we have seen the board reviewing BRS only as an information item. Like some information has been prepared and forwarded to them. And there isn't any we can what we no formal approval of ESG governance. There isn't any system where they are going to approve this whole ESG data and this structure. There isn't any no documented oversight of assurance findings. And really, this creates a serious issues because assurance standards expected demonstrable oversight, not verbal awareness. And the third major gap is that ESG risks are not integrated into enterprises risk management of the organization system. So like climate risk, workforce risk, supply chain risk, they are discussed in isolation. If at all, they are not mapped into the corporate risk register, not a fixed mitigation plans for all. There isn't any proper system for that or internal audit coverage. And when this happens, assessors ask a very uncomfortable questions like, if this is ESG risk is material enough to disclose publicly, why is it not material enough to appear in your risk frame? So this really create confusion even among assurance agencies or individuals who are providing assurance to them. And there isn't any answer from even from industry side. And the fourth gap is there isn't any linkage between ESG performance and leadership KPIs or incentive. In assurance reviews, this matter more than the people realize. If ESG has no impact on management KPIs or remuneration, assurance team questions whether ESG is truly embedded or whether it is only disclosure driven. And finally, a very practical and sensitive gap is that there is confusion between consultant and assurer role. Many companies expect the same companies to design ESG framework, prepare BRSR data, support management responses, and still be around during assurance period. So this is clear independence risk. I have seen engagement. I mean, in fact, we sometimes we have to inform to our client also, uh, and really, I have seen few engagements where, due to this issue, timeline were slipped, and management had to work at the last minute. Now, when all these governance gaps exist together, the outcome is predictable. So, like finally, assurance becomes lower. Testing becomes, I mean, whoever is doing testing or identifying gaps, so they have to deep dive due to these gaps. And even documentation requirements, whatever is required for cross-checking data and KPIs, whatever has been reported. For that, assurance team have to deep dive and require multiple data due to these gaps. Even pressure in last minute pressure on management also increases. So conclusion of this issue is that weak governance at the start will always convert into a pain to the management, and not only to management, to assurer who are doing assurance for all this data. So here we are going to discuss common data and methodology gaps. So in this slide, we will deal where most technical assurance failure actually originate: data, logic, and methodology discipline. So let me walk you through the most common gaps we see repeatedly. The first and most damaging gap is inconsistent boundaries. Financial reporting follows one consolidation logic. GSG inventories follows another. BRSR disclosure follow a third. So during assurance, when we try to reconcile revenue, headcount, energy, emissions, so these numbers simply don't align. These immediately raise a material inconsistency issues. The second is undocumented emission factor source. Teams may be using DEFRA, IEA, CA, or internal assumption for references. But when we ask which version, which year, which source, why this choice, there is often no documented answer for this basic emission factor, how they have included. So they are unanswerable for this also. So from an assurance standpoint, undocumented emission factors are uncontrolled assumptions. So, and the third gap is unclear intensity denominators. For example, emissions per ton, emission per revenue, emission per unit. So if the denominator is not clearly defined, approved by the ESG body or sustainability body or sustainability team in the companies, so intensely KPIs lose all audit credibility. And in fact, it is also inconsistent. Somewhere emission per ton they mention, somewhere per unit. So it has to be uniform in all the data across all the data. And the fourth gap is site level inconsistency in safety calculations. On site calculates LTIFR based on employee only. Another site includes contractors, overtime workers. So when we consolidate this data, the KPIs become mathematically invalid. And the fifth gap is HR and payroll. In fact, HR and payroll data not reconciled with their social disclosure. So we frequently what we see here, employee count in BRSR not matching payroll data, gender ratios not matching HRM's data, training hours inflated due to duplicate counting. So in essence, HRMS is treated as a system of record. Anything that doesn't reconcile to get its question. So this is main issue here. So we have to, I mean, the sustainability team or management who are engaged in this KPIs have to keep a have to treat HRM data as a system record. And the sixth gap is absence of base year and restatement policy. So companies acquire, divest, reorganize, but historic ESG data is not restated. I mean, this breaks trend analysis, targeting, tracking, and comparability. And finally, misalignment with industry standards definitions. So internal definition may sound logical, but if they don't match prescribed standards, they fail assurance. And this most data failure are not due to bad intent, but they are due to weak methodological discipline. So, what common process? And here we are going to discuss. The slide will I have highlighted operational weakness that don't show up on paper, but explode under assurance pressure. The first gap is absence of formal SOPs. So data collection happens through emails, calls, and individual judgment. So every year the process changes, dependency changes, and knowledge sits with individual, not system. From assurance perspective, undocumented process or uncontrolled process. So, like if you have not controlled your document, you have not documented your process. So this is major gap what we have seen. The second gap is no structured evidence library per KPI. Evidence is scattered across email threads, shared drive, sometimes through WhatsApp. People used to share their internal data, personal laptops. Sometimes data remain in someone's personal laptops. So when assurance starts, teams spend days just locating documents. So in these cases where uh, I have seen cases where correct data existed, but evidence could not be retrieved in time, leading to avoidable observations. So the third gap is casual handling of third-party data. Like most of the companies uh, not maintaining their data related to their third party. So like when we are saying here third party, that means the waste handlers, transporters, training partners. So like data comes through emails without verification or validation or audit trail, because internally they have not maintained the systems to verify or validate data, whatever they have data generating or whatever data they are receiving. So assurance teams treat such data as a higher risk inputs. As a assurance professionals, we really treat this data with the high risk inputs. And the fourth gap, we found that weak ITSS and changes control. So like multiple people can edit the same ESV file. There isn't any version control or approval logs, how to handle data and how to maintain this data. So in assurance, this raises simple but powerful questions. How do you prove data integrity? I mean, if there isn't any control versions of documents or approved logs, so that means that your data is not, that seriously raise question marks over your data integrity. And the fifth gap is undocumented calculation logic. Excel model, evolves silently, formulas changes, links breaks. But when asked to explain the final number, even internal teams struggle. Same, there is one more gap, like we discuss here five gaps here, what we see in documents. And the sixth gap is no internal mock audit or dry runs. For many organizations, the first real challenge comes directly from the external assurer. This is exactly the wrong time to discover gaps. The result is last minute document hunting. At last moment, management will take a stress that document is not mapped or controlled in right manners. So they will extend assurance timeline, and unnecessary they will escalate this assurance process. So weak process don't fail during reporting, they fail during assurance. Let us discuss value chain ESG. Value chain, as I said, that in coming time there will be pressure on value chain as well for all organizations. Value chain ESG is next major assurance disruption waiting to happen in assurance, BRSR, especially in BRSR assurance. While most companies are still struggling to stabilize internal ESG data till now, assurance expectations are already shifting outside the organizations to its suppliers, vendors, and extended value chain. Like industries are not able to control their own data, but now due to regulatory pressure, they have to handle their third-party vendors' data, suppliers' data. So this gap between where companies are and where assurance is heading is where future qualification will originate. The first and most fundamental gap is the absence of supplier mapping based on CBI as SEBI threshold. In many organizations, there is still no clear understanding of which supplier crossed the 2% individual spend threshold and which suppliers together accounts for 75% of total procurement spend. So without this prioritization, value chain ESG effort become random, unstructured and inefficient. So with resources spent on low risk suppliers while material risk remain untouched. And the second major gap is the absence of ESG clauses in supplier contracts. So without explicit contractual provisions, companies have no enforceable right to demand ESG data. They have no authority to question data quality or methodology, and they have no leverage to require corrective actions or improvements. So company have to incorporate ESG clauses in their suppliers contract. This is only basic method where where they can control suppliers data. So they have to enforce their suppliers by incorporating these ESG conditions in their vendors contract. From an assurance perspective, this is a really structure weakness because you cannot assure data that you do not have the right to obtain or challenge. That's why every industry, every organizations right now who are going to face value chain assurance or who have to report their value chain ESG data, they should incorporate ESG clauses in their supplier contracts. And the third gap is lack of supply sensitization and capacity building. So most suppliers, especially MSMEs, have no understanding of how to calculate emissions, how to track social or safety KPIs, or what evidence is expected under assurance. So they have to be trained, they have to be sanitized about this requirement before putting this terms and conditions in contract agreements. And yet company still expect accurate, I mean, without sensitization of this ESG requirements, companies still, companies are still expecting accurate, consistent and comparable data, which they are not going to get and which they don't get. So this inevitably led to garbage in, garbage out. And assurance team see this as a failure repeatedly during verification. So that's why we focus checking the contract documents of the industries, whether they have incorporated EHS or ESG conditions in their contract documents or not. And the fourth gap is over reliance on unchecked self declarations. So from an assurance standpoint, we can say that uh, uncontrolled self declaration will equally will high risk. If there is no validation logic, no reasonableness checks, and no escalation mechanism, self declarations cannot be relied upon, and it will really attract assurance limitations for qualifications. And the fifth most strategic gap is the absence of a multi-year improvement roadmap. Many organizations attempt to fix value chain ESG in a single reporting cycle. That approach almostly always fail. So you have to give time. Lot of industry right now aren't reporting or collecting their value chains data, because they are not right now, they are not under that requirement or compliances which has been imposed by SEBI. But they have to practice from this time, so that in coming 2 to 3 financial year they are able to get right and correct value chain data, because value chain ESG does not mature overnight. Like if you have control over your own organization, your own industry, so you can evaluate in 1 or 2 financial year if you have financial and operational control on your organization, but you don't have operational control on others organization. So obviously that will take time. Value chain ESG improvement will take time. So it actually requires in phase maturity, structured supplies onboarding, and gradual tightening of controls and expectations over time. So without this roadmap, improvements remain cosmetic and assurance outcome will remain weak. Whatever you do, you can't report value chain ESG data accurately. So for that you have to give 2 to 3 financial year. So value chain ESG is no longer future risks. That's why this slide topic was value chain ESG is no longer future risk. It is present day preparation risk. And the decision you make today will directly determine your assurance outcome tomorrow. Governance and like for BRSR. So mature organizations do not run BRSR from one department. They establish a formal ESG or BRSR steering committee with cross-functional representation. Typically, finance on numbers, HR on people metrics, EHS on safety and environment, procurement on value chain, legal ensures compliance, IT ensures data integrity. At board level, they approve a BRSR governance charter. So this charter basically define oversight, review frequency, and assurance responsibility. So from assurance experience, if I say, so this single document significantly reduces scope creep. Like next comes the for every KPI, it is must be clear for each and every KPIs, whatever KPIs you are reporting in your organization, or I can say in industry. So it should be made crystal clear who owns data, who prepares these KPIs, who reviews, who sign off. If any role is missing, assurance risk will automatically increase. So advanced organization, they integrate their easy KPIs into risk dashboard and management reviews and sometimes incentives. Once ESG affects accountability, assurance confidence improve automatically. KPI register for BRSR code. A KPI register is basically a technical backbone for BRSR assurance. It answers most assurance questions before they are even asked. Like for every BSR core KPIs, it captures definition, boundary, source system, owner, reviewer. In engagement where KPI register exists, assurance is faster, fewer follow-ups, fewer surprise. In engagement where it doesn't, interpretation debate, naturally it will dominate. Without a KPI register, BSR runs on assumption. So with it, BSR run. I can say that with your KPI registers, BSR will run on governance. Controls are where assurance either becomes smooth or painful. Simple control like meter sign-offs, HR extraction approvals, reasonableness check. It will prevent 80% of downstream issues. Now let me stress the importance of guidance assurance. So guidance stimulate real assurance pressure, data sampling, evidence requests, recalculations. I have seen companies that reduce assurance findings by over 50% just by running one proper dry run. So discovering gaps intern is very cheap. Discovering them under external assurance is really expensive. So I think industry should do conduct their dry run assurance to identify gaps and resolving that issues or whatever gaps they are finding internally. Value chain ESG cannot be forced, as I was saying in our previous slides. So it must be phased. So here we are going to what strategies should we adopt in practicing or enforcing value chain. So like if we go year wise, so in first year we can say that we can do supplier mapping, awareness for our vendors and suppliers, basic data. We can ask them a basic data for like GSE, water, and other sustainability metrics. In next, like again in next year, we can do quality checks, sampling, and we can give them corrective feedback on their data, whatever they are reporting. Again, in next financial year, we can ask them assurance ready data supply. Like we can ask whatever data they are providing that need to be assured, that need to be verified. So that this will really protect suppliers from SOC. I mean, I mean, if in this financial year we are going, we our industry is going to face value chain assurance, or we, scope three from GSC perspective. I speak so like scope three assurance. So we shouldn't give SOC to our supplier. So that's why uh, this need to be moved gradually, and it will help from the organization or companies also to get a verified and assured data on which they can on which trust can be, I mean we can be, as assurance or audit provider can trust. So phasing turns value. I mean, basically, phasing will turn this value chain ESG data into we can say a maturity journey, or no, it will not create a conflict among your vendors or your suppliers, or you don't have to strictly enforce them. Like we want data from validated or verified data from this financial year. So that's why industry organizations who are reporting under right now who are reporting need to practice this from existing financial year or coming this financial year. So one very important thing that many organizations misunderstand about assurance is this: not all KPIs carry the same audit risk. In assurance planning, the first thing we do is to check all KPIs equally. We don't discriminate, like we are going to check only GSD data, or we are going to validate only your HR data extensively and not to check other data. So this does not happen practically. So like we check all KPIs equally and we treat all KPIs equally. So we risk rank them. We basically like high risk KPIs are those that are financially sensitive. Operationally, it is complex and highly visible to regulators and investors. So in BRSR core, these typically include GSD emissions like energy consumption and renewable share, water, water withdrawal, LTIFR, and wedges. So for this KPI, assurance team do not stop at summary numbers. They go down to site level data, transaction samples, supporting documents, and year on year trend logic. I have seen cases where 1 week energy meter at one plant or one incorrect man hour calculations, and it lead to expand testing across the entire organizations. Then we have a medium risk KPIs. Then we have medium risk KPIs. So these usually include waste management, training hours, supplies ESG coverage. Here, basically here assurance focuses on reconciliation, sampling, procedural consistency, and then finally there are low risk KPIs. So here we are going to discuss fixing JSC disclosure failure. So in almost every ESG and BSR assurance engagement, GSD missions are the number one source of qualifications and observations. This is not because companies don't try. It is because GSE data is technically complex and structurally fragile. So let me highlight the most common root cause here. First is inconsistent organizational boundaries. A site is included one year and excluded the next without explanation. This immediately it break trend credibility. Second is undocumented scope to methodology. Companies switch between location-based and market-based methods. So without formal documentation approval. So from assurance perspective, undocumented unchoices are really unacceptable. Third is missing or outdated emission factor sources. Factors are used, but no reference here, no version, no source documentation. So this turns calculation into assumptions. And the fourth is a diesel double counting. Like diesel appears once as a fuel consumption, again under diesel electricity. So this inflates emissions and raises serious red flags among the data. Fifth is absence of a base year and recalculation policy. Without a base year, reduction claims are meaningless and targets are unverified. So now there is the good news that the fix is simply not complicated. So if you have fix your data and it's so like one single GSC boundary aligned with financial consolidation, one log calculation workbook with factor sources and checks, one formally approved base year and restatement policy. When these three exist, I have seen GSC related assurance findings reduce dramatically. Energy, water, and waste controls. So energy, water, and waste KPIs look operationally simple, but in assurance, they are some of the most frequent challenging metrics what we have found till date. So let's start with energy. Energy failures usually happens when common utility bills are split using assumptions. Submetering does not exist. Allocation logic is basically they are undocumented. So what as assessor, what we ask, how do you prove this that this energy belong to this plant? And there isn't any answer for this. If you say about water, so water assurance fail. Basically, reason is behind this is that bore wells are unmetered, groundwater permissions are missing, estimated figures are disclosed without any explanation. So in some cases, this becomes both an assurance and a regulatory issue. Waste disclosures fail when recycler authorizations are expired. Many manifests are missing. Weighbridge slips don't reconcile what exactly you are reporting. So from assurance's perspective, unsupported recycling claims are treated as unverifiable. Most effective fix I have seen is very practical. A compliant register map directly to BSR KPIs, like which includes meter readings, borewell permissions, recycler authorizations. So they are systematically linked to disclosures and other high risk KPIs. With me, we have our industry experts and Mr. 𝗔𝘀𝘀𝘂𝗂𝗂𝗂. He is going to take over from here. And Dushyant, are you there with me? He is going to
Yes,
detail you about, yes,
thank you, Abhinav.
please.
Thank you. And I think you have given a very wide perspective from the auditor's lens about what are the major drawbacks, or I may say, like you have given an entire checklist kind of the thing to all the participants today, that on what parameters, what major points they need to work upon, and they need to lay a special emphasis while they are preparing for the BSR report, and what benefit they can get for conducting an assurance. So like definitely getting an assurance done for the report adds a lot of value to the report, and definitely it increases the high credibility in the market also. So I will just be restricting myself towards the principle 6 of the BRSR that talks only about the environment data. And since like you have highlighted the importance of the assurance, so I will be just touching upon the main pointers that need to be focused from the environmental point, like how it matters, how BRSR is matter a lot from the business profit angle. So BRSR shall not be seen from the lens of environmental compliance. First of all, it has now become a environmental competitiveness in a business, since environmental performance today directly impacts on profit, growth, talent, and the investor confidence in India. So these are the major factors that directly impact and are associated with the company's profit. Also, adding further, like BRSR should not be taken as a cost. It is just a performance framework for reporting data under Principle 6 of the BRSR that is related to the environment. Companies, what they do, they need to do the measurement of energy, water, emissions, waste. And when they are doing this, they are identifying the environmental risk associated with their business. Also, the resource efficiency that they are having. And they will also be heading towards the reduction targets. So when they're heading towards the reduction target, definitely they are improving their system. For business, this brings real impact since what get measured, this is my perspective. What is ever get measured gets managed, and whatever gets managed gets optimized. So this is my funda, and it definitely apply a lot to the business profit. Also, BRSR brings to your business profitability, that is lowering the cost and providing a better margins. How it is connected. Let me give you a small example. All Indian cement and steel companies reporting under BRSR have focused on waste heat recovery, fly ash usage, and renewable power, leading to the sustained cost savings and marginal stability. So we can say directly that environmental efficiency is equal to operational efficiency. So because reduced energy, reduced fuel consumption, lower water procurement, treatment costs. So this definitely helps to reduce the cost. And with the reduction in the operational cost or the production cost, definitely the market profit margins will be increased. So you can say, like, as I mentioned in the first point, BRSR shall not be taken as a cost. It definitely will give a return if you take it in a longer vision, long-term vision. Also, assurance enhances customer trust. Nowadays, companies' market access is also enhanced when you are getting your report assurance done. Government tenders nowadays are increasingly including the environmental criteria. They are giving the environmental criteria as a qualification criteria in their tenders. So large corporates of many of the companies, as MSME companies, they are vendors, whether upstream or downstream vendors of these large corporates. So these large corporates are always preferring the vendors which are ESG compliant. So if your report is third party assured, then you have a stronger qualification for the public and private tenders also. Next is, like, assurance also leads to investor attraction and reduces cost of capital. What investor is looking for? Investor is always looking for the climate risk preparedness of the company. Wherever they are investing, they need to know what is the company's preparedness towards the climate risk, and do they have done their resource efficiency, and is their investment going in a company with a vision of long-term sustainability. So, like example, Indian banks, mutual funds, global investors, they are integrating BRSR environmental disclosures into credit and investment decisions. So now the credit and investment decisions, loan decisions from the banks, they are also considering the sustainability reports. And the assured report definitely adds a credibility to it. Also, now today is a generation of internet, and people are more independent, and they are more aware. So employee attraction and retention also becomes one of the most key impact, and you can say the aspect of the BRSR. Workforce expectation, if we see, employees are more interested towards joining the company which is purpose driven. So that has a purpose. So BSR Principle 3 talks about the business should respect and promote the well-being of all the employees, and they also cover the value chain. So when you are disclosing under Principle 3 of the BRSR, it covers occupational health safety management system, that covers ISO 45001, identification of the work-related hazard and risk assessment. So when these parameters are covered, so this gives a pride to the employee who is working in the organization. So next is the supply chain resilience. What is supply chain resilience? BRS are pushing the companies to engage their suppliers also. With this, what is happening? The tracking of scope 3 emissions and promoting responsible sourcing. So large manufacturing companies, they are also cascading the ESG requirements to their MSME suppliers. So what is happening? Because of this, they reduce their disruptions and regulatory exposures. So whenever this requirements of ESG is cascading down to the value chain, definitely a risk to the supply chain is reduced. Because today, if you want your business to be sustainable, you must have a resilient supply chain. And that resilience starts with environmental accountability. And one most important and the last parameter that I would highlight as the, you can say, that can push the companies towards BRSR and changing their mindset is like nowadays, since BRSR is having a board level engagement, environmental data is reaching to the board. And board members of listed companies are increasingly reviewing the climate and environmental matrices alongside financials, due to which better capital allocation decisions with long-term risk visibility can be taken. So now the decisions which are taken for the expansion of a company, for investment, they are more focused towards the sustainable business. So that is also important aspect that has been driven by the BRSR reporting. And BRSR reporting will help prepare companies to get the future proof to any compliance related to the sustainability. If you are reporting through BRSR, I am definitely sure if you get two financial year consecutively audited by a third party, then in the first year, whatever gaps are there in accounting and reporting, those gaps will be identified through the assessment. And one post assessment, you will be definitely plugging those gaps. The company will be plugging those gaps. And whenever you will be coming for the next assessment, that is the next financial year, then those gaps will be verified. The action taken for those gaps will be verified. And then they can be proven that they are in line with your target. The target that you have set, whether it can be a net zero target, that it can be a rating target or something under CDP or any other ESG rating. So definitely getting the report assurance is adding a credibility, bringing more profit to the business, will reduce the capital cost, will make the decisions more in line with making the business sustainable in nature. So that with that also only, I will just like to close my argument and information and will pass on to the Abhinav. Thank you, Abhinav, for giving the time.
Thank you, Dushyant. I mean, it was very insightful, and thank you once again. Yes, so really, Dushyant, present. Thank you for sharing your experience once again. And let's continue from safety. What issues we face when doing assurance for BRSR for LTIFR safeties. So LTIFR is one of the most I can say that it is the most frequently misreporting KPIs across the industries, and the reason are remarkably consistent. So, the first failure is excluding contractors. In many manufacturing and infrastructure setups, contract laborers forms the majority of the exposed hours. So, excluding them materially underestimate this risk. The second failure is using headcount instead of man hours. LTIFR is an intensity matrix. So headcount ignores overtimes, shift patterns, and contractor. It will give exposures to contractors. And the third failure is incorrect injury classification. The first eight cases are shown as a lost time injuries, or lost time injuries are downgraded. So both scenarios are really problematic. And to fix this, it's very clear and defensible. So like total man hours most must include employees, contractors, and overtimes. Injury classification must align with Factories Act and ILO definitions, and that should be mentioned in each and every document and process, whatever it is reported. Contractor safety must be governed with the same way as employee safety. So when these three corrections are implemented in this section, in this under this KPI, LTIFR automatically move from high risk KPIs to stable and auditable metrics. Next, we are going to discuss social KPIs. So, how to fix this social KPIs versus diversity and trainings. So, social KPIs are often underestimated, but they attract intense scrutiny during assurance. Let's start with the wages and wage ratio. So, the most common error is using a single average wage. This hide real disparities. So when we are doing assurance, what we expect is role wise, grade wise, and reason wise comparison. So without this, wage parity and disclosures will definitely will lack credibility. Now, second is diversity, a very common issues, and the very common is excluding contractors and long terms outsourced staff. So it if operation depends on them, excluding them will really present a distorted workforce pictures to auditors. And the third one is training hour. Third one is training hours. So training data often fails because induction programs are conducted repeatedly. Mandatory compliance training inflates totals. So when we do assurance, what we expect separation by training types, unique participants count where relevant. In short, we can say that social KPIs must reflect how work actually happens, not how organizational chart how looks. So when we talk about value chain data reliability, as we were discussing previously, so applying the same assurance intensity to all suppliers in neither realistic nor necessary way. So that is why mature organizations follow a tiered supplied assurance model. Like if we say if we categorize uh, our suppliers into 2 or 3 or 4 categories. So like if we divide it into tier 1 suppliers, so you that their high spend, high risk patterns will be required for them, like document verification, certification, sometimes site visit have to be conducted. Tier 2 suppliers follow. They have to provide the easy declaration, desk-based verification, and trend analysis. Tier 2 suppliers are governed mainly through codes of conduct, basic declarations, and these tied approaches balances data reliability, cost control, and operational practically. Without this structure, companies either over control low risk suppliers or under control high risk ones. Both situations increases and these situations increase assurance exposures. So next slide is what causes qualified adverse opinions. Now let me address a very sensitive but very real topic here. What actually leads to qualified or adverse assurance opinions? In practice, most qualifications do not happen because companies did nothing. They happens because of few critical assurance expectations were ignored. The first and most common trigger is contradictory clauses. I think we are on 5 teens. Okay, so we are sorry, we got actually slightly late, but I will try to explain. There are more few 2 to 3 slides, and I will try to explain those all slides to you guys. So like slightly I have to take things forward. Okay, so the first and most common trigger, as I was discussing, is contradictory disclosures. The same KPIs appears with one number in BRSR, a different number in sustainability report, and yet another number in the annual report or investor presentations. So from an assurance perspective, this is fatal to credibility. If management cannot reconcile its own disclosures, an assurer cannot conclude reliability, because ultimately assurer depend upon all your disclosures whatever you have reported in your different sustainability report or BRSR report or other report, whatever you are reporting under different frameworks. And the second is trigger is missing or insufficient evidence. Numbers may look reasonable, but when asked for supporting documents, invoices, system reports, log, approvals, they are either missing or incomplete. So in assurance language, a number without evidence is treated as unverified, even if it is factually correct. The third trigger is unsupported management estimates. So estimates are allowed, but only when supported by methodology, assumptions, benchmarks, and sensitivity explanations. So when estimates are used casually, assurance teams are forced to qualify. And the fourth trigger is independence breach. When the same consultant designs the ESG framework, prepares the data, and influences assurance discussions, so this becomes a non-negotiable ethical issues. I have personally seen engagements where assurance acceptance was withdrawn or a scope was very severely restricted. So due to this independence concerns, these thing usually happens. Now here's the most important consequences to understand. Once a qualification appears, the issue no longer stays with the sustainability team. So to it escalates basically to the audit committee, investors, proxy advisors, firms, and in some cases whoever is reporting in SEBI, so definitely their financial financial investors, there will impact on financial investors as well. So let me very clear about this. I mean, this a qualified opinion is not a reporting problem. It is a governance and capital market problem. A truly assurance-ready organization does not depend heroics in the last quarter. It operates with built-in discipline throughout the year. Such organizations will always have a broad approved ESG and BRSR governance framework, formally documented SOPs or ESG data, a centralized ESG data and evidence repository, quarterly ESG reviews at management level, at least one complete mock assurance or dry run assurance uh, will be conducted from the organizations, a structured value chain ESG rollout, and a clear separation between data preparers and data assurance. Assurers. So in these organizations where these things have been are being practices, assurance meetings are calm, document requests are made quickly, discussions are technical and not defensive. In contrast, where organizations that are not assurance ready, what we face, their last minutes, this firefighting like situations happens, repeated follow-ups we have to put, and this escalation, there are chances of escalations with management. And the difference is not intent, and difference is basically here discipline. So organization who want to be assurance ready do not prepare assurance in 1 year. So like if you are going to fall or lie under this compliances, you have to be ready uh, from this financial year. Now we are what we how we see data, how we externally we evaluate you. So to many organization, assurance feels subjective, but in reality, assessors follow a very structured evaluation logic. First, independence check. Before touching data, assessors check who prepared the data, who designed the framework, and whether conflict exists. Any overlap have to be immediately raised or have to show that concern to concerned person. Second is scope and boundary testing. Assessors verify whether ESG boundaries match financial consolidations, material sites, subsidiaries, and JVs are included or not. Third, control design testing. This include maker checker controls, approvals, ITSS and version controls. Fourth is high risk KPI sampling, like deep testing is done on GSZ, energy, water, LTA, fire, wages, like data in deep and detail. Fifth one is cross report consistency. So numbers are reconciled across your BRSR, sustainability report, annual report, investor disclosures. And finally, management response quality. Issues are not a problem. Poor response, delay or defensiveness is here. So in simple word, I can say assessors do not just test numbers, They test governance behavior. So, 2025-26 readiness checklist. So this readiness checklist is meant for honest internal reflection, not for comfort. Anything making green means documented, implemented, tested, and evidence-backed. Anything making yellow, that means partially in place, fragile under assurance pressure. Anything making red means guaranteed stress point in the next assurance cycle. So from experience, I can tell you this. Every yellow and red item today converts directly into higher assurance cost, longer timelines, deeper testing, and senior management involvement. So this checklist gives you the opportunity to fix issue on your own timeline, not under external pressure. So to final conclusion is that BRSR is no longer just a disclosure document. It is no longer about filling tables, copying last year's narratives, or aligning language with what Ps are publishing. So BRSR today has become assurance grade as ESG information. Information that must withstand structure, testing, scrutiny, and independent challenge. So every number, every statement, and every policy is now expected to be traceable, defensible, and have to be supported by evidence. So not only at corporate level, but down to site and process level. Second thing is that from 2025-26 is your preparation window. This is phase where organizations still have the opportunity to build, correct, and stabilize before expectations harden. This is when governance framework must mature in your organizations. Like roles, honesty, and accountability must be clearly defined and operationals. So, like second is control must stabilize. When I say control must stabilize, that means data collection, approvals, validations, and review must become routine. Not it shouldn't be reactive. Like it should be routine within your system. Third one is supply system must be built. Because upstream ESG data will no longer be optional or assumptive. You have to prepare your supply system. You have to build your supply system. Once this window passes, I mean 25-26, regulatory and assurance expectations will no longer focus on intent or roadmap. They will focus on executions and what are your results. And third, and this is critical to understand, third point is flexibility in assessment. Flexibility in assessment does not mean flexibility in discipline. Like yes, assessors may recognize phased maturity and evolving systems, but they will never compromise on integrity or information, availability of or reliability of evidence, and independence of process and controls. If data cannot be evidence, it cannot be assured. If processes are informal, they cannot be relied. Assurance, whoever assurance agencies are, they will not rely upon that. And if roles are conflicted, there will be questions. The that era of narrative-driven ESG, where storytelling was enough. I mean, right now, what we can say that is over. So we have now fully entered into ESG, assured ESG era, we can say, where credibility will be earned through systems and controls and proofs and evidence. We can say traceability of your data. So thank you all for joining this. If there is any questions, you can ask now. I think Dushyant is with us, or you can email us regarding any issues or any conversation or any other informal discussion. If you want, you can email us regarding this. Like we hope most of you knows about KBS. So at KBS, our role basically it goes beyond during assurance conclusion. We support organizations across all critical readiness layers. Thank you everyone for joining. And if I will also request you guys to share your feedback on this. A feedback form will be shared with you all, and you guys are most welcome for asking any questions or any discussion to us. Hope you all have. I think Amit have shared feedback form for all you guys. This is our email ID. You can note down, and you can have any, if you have any query or any discussions, if you want to have with us. So you can connect over this email or a number. Thank you all. Thank you for joining this program. Thank you, Bhusan sir. Okay, I think Amit, let's. Thank you once again, everyone. And Dushyant, you want to add something here, or should we close this session?
Thank you, Abhinav, for the insightful webinar and your time that you have dedicated for bringing why assurance is required, what is the importance, and what are the, as per your practice, as per your engagements with the different assurance bodies and different assurance engagements related to the BRSR, sustainability, and every other. So you have clearly, like, the person might get this kind of insight after facing more than 10 or 20 audits. So, but you have narrowed them in just 1 hour to all the participants. And definitely the participants will get a lot of help if they have listened to the points, and they will work on these points and build their system accordingly, and maintain the traceability of the evidence as you have mentioned. And and very much you have given a right point that this era of storytelling when it comes to the sustainability has gone now. Everybody is aware, and whether it's the customer or the investor or the other stakeholders in the business, everyone is aware of the parameters. Everyone is aware of the terms like greenwashing. So it is it's very much important for the companies to be careful regarding submitting their data, drawing the line on greenwashing and other very critical informations, like what are the basic steps, what are the initiatives that they have taken, because these are the quality points that attracts the stakeholders towards a company, that can bring a company right at the top and can even bring the company right at the bottom. So it's high time to act accordingly in the business. Thank you. And
Okay, thank you, Dushyant.
definitely it was a really nice webinar. Thank you, Abhinav. Thank you for your
Thank you,
time.
Dushyant.
Thank you all.
And
I really thank all for joining the webinar, and please stay connected to the LinkedIn page of the KBS, and do visit the KBS site. So we have multiple products related to the sustainability, climate change, management services, and the training vertical, especially that the services we offer, cross-functional services, the third-party inspections. So stay connected to the KBS for the future updates regarding the compliances,
okay,
regarding the knowledge sharing. Thank you all.
thank you, Dushyant. And yes, this link will be shared for this presentation. Um I mean, recorded session. This recorded session will be shared on each and every individual's email ID. Thank you all. Thank you for joining.